There is a single question that haunts the mind of every person who has ever looked at a stock chart. It's a quiet, persistent whisper in the back of the skull that grows louder with every green flash and every red plunge on the screen. The question is, how do you find the winners? How do you sift through the thousands of companies, the endless ticker symbols, the blizzards of news and data, and pinpoint that one stock, that one opportunity that will change your financial life forever? We spend our days, our nights, our precious mental energy hunting for this secret. We read books about it, we watch videos about it, we listen to so-called gurus who promise they have the formula. We are a culture of hunters, armed with sophisticated tools and a burning desire to find that elusive prize. But what if the entire premise is wrong? What if the secret to winning isn't about finding the winners at all? What if the greatest financial fortunes of the last century were built on a foundation not of brilliant discovery, but of brilliant avoidance? This is the story of a mental model, a way of thinking so powerful, yet so simple that it feels like a trick. It's the intellectual razor used by Warren Buffett and his partner Charlie Munger to shave away 99% of all investment opportunities, leaving them with a small, manageable universe of near-certain successes. This isn't a stock tip. It is a fundamental rewiring of your brain's approach to complex problems, a transformation in your decision-making process that extends far beyond your portfolio management. The principle is called inversion, and it begins not by asking how can I succeed, but by asking a much darker, much more potent question: how could I fail? If you can identify all the possible paths to ruin, all the trapdoors and hidden poisons in the investment landscape, and simply make it your life's mission to avoid them, what you are left with, by process of elimination, is success. You stop trying to be clever and instead focus on not being stupid. And as you will soon discover, in the world of money, avoiding stupidity is a far more powerful strategy than striving for genius. We are about to embark on a journey to build this mental tool, piece by piece, pillar by pillar. We will not just learn what it is, we will embed it into your thinking. We will explore the fatal flaws in companies that lead to ruin, the death spirals, the leadership deficits, the crumbling competitive moats, the delusions of price, and the siren song of industries you don't understand. For each, we will learn how to build an impenetrable wall of avoidance. This isn't about finding the needle in the haystack, it's about learning how to burn the haystack down. The needle will be all that remains. Our first pillar, the first great wall we must build in our fortress of avoidance, is designed to protect us from the most common and catastrophic disease that infects corporate America, the death spiral. To understand its power, we must travel back in time, not to a story of a brilliant stock pick, but to a story about a business that became one of the cornerstones of the Berkshire Hathaway empire. The year is 1973. The United States is in turmoil. The stock market is collapsing in what would become one of the worst bear markets in modern history. The so-called Nifty 50 stocks, the darlings of the era, are being eviscerated. Amidst this panic and despair, a 43-year-old Warren Buffett is not panicking. He is shopping. And one of the companies that catches his eye is the Washington Post. To the outside world, this looked like an investment in a newspaper, a business of ink and paper and delivery trucks. But Buffett, applying his unique lens, saw something entirely different. He saw a financial fortress. What did he see? He saw a company that did not need debt. The Washington Post, along with its television stations and Newsweek magazine, was what Charlie Munger would later call a gusher. It produced torrents of cash, far more than it needed to operate and maintain its business. Think about a normal business, a manufacturing plant or an airline. To grow, they must constantly spend enormous sums of capital. They need new factories, new machines, new airplanes. And to fund this growth, they almost always have to borrow money, taking on debt. They are on a capital expenditure treadmill. The Washington Post was the opposite. Its primary asset wasn't a factory, it was its reputation. It was the dominant newspaper in a powerful city, creating a local monopoly on information and advertising. To grow its revenue, It didn't need to build a billion-dollar plant. It just needed to sell more ads in the same paper it was already printing. The cost of adding one more ad was almost zero. This meant that the business required virtually no new capital to grow. All the cash it generated was free and clear. It could be used to pay dividends, buy back stock, or acquire other businesses. It wasn't beholden to bankers. It didn't have massive interest payments draining its lifeblood each quarter. Buffett saw that this financial structure made the company incredibly resilient. When the 1973-74 recession hit hard, companies loaded with debt were facing bankruptcy. They had to pay their interest costs whether their sales were up or down. The Washington Post, with its pristine balance sheet, sailed through the storm. Buffett invested over $10 million, a huge sum for him at the time, and it became one of his most successful investments ever, not because of some brilliant insight into the future of journalism, but because he inverted the problem. He wasn't looking for a business that could grow explosively using borrowed money. He was actively avoiding the type of business that needed church to. He was avoiding the path to failure, which is a business model that is fundamentally dependent on the kindness of creditors. The psychological principle that makes debt so seductive and so dangerous is a potent cocktail of cognitive biases. The most powerful is what we might call extrapolation bias, a close cousin of the hot hand fallacy. When we see a company reporting explosive growth, soaring revenues, expanding operations, splashy acquisitions, our brain naturally draws a straight line into the future. We see the recent past and project it forward indefinitely. If a company grew at 30% for the last 3 years by taking on debt to fund its expansion, we instinctively assume it can continue doing so. We see the leverage not as a risk but as the engine of that exciting growth. We fall in love with the story. This is amplified by complexity bias. The average retail investor looks at a company with a complex balance sheet, with various tranches of debt, convertible bonds, and sophisticated financial instruments. And they don't see red flags. They see sophistication. They think, wow, these guys are smart. They must have brilliant Wall Street minds running their treasury department. In reality, complexity is often where fragility hides. A simple, clean balance sheet is understandable and robust. A complex one is opaque and brittle. It's a house of cards waiting for a stiff breeze. The executives of these debt-laden companies become master storytellers. They talk about strategic acquisitions and investing for the future. They use the borrowed money to put up impressive numbers in the short term, and the market, addicted to the narrative of growth, rewards them with a higher stock price. This creates a feedback loop. The rising stock makes it easier to borrow more money, which funds more growth, which pushes the stock higher. For a time, it looks like genius. But beneath the surface, the foundation is rotting. The company is becoming a slave to its interest payments. Every dollar of profit is spoken for before it even arrives, earmarked to go to the bondholders. The company loses its flexibility, its ability to innovate, to weather a storm, to invest in its own future. The management, once focused on building a great business, is now focused on managing the debt. The retail investor, caught up in the story, sees none of this. They just see the upward sloping line of the stock chart, a line drawn by the intoxicating but ultimately poisonous ink of borrowed money. They fail to invert. They ask, how high can this go? Instead of, what happens when the credit markets freeze, when interest rates rise, when a recession hits, and the revenue that supports this mountain of debt suddenly disappears? So how do we, as intelligent investors, translate this principle into a concrete, actionable blueprint? We create what we will call the debt filter. This is a simple, non-negotiable mental model that will instantly eliminate the vast majority of dangerous stocks from your consideration. It requires no special software, just a few minutes with a company's financial statements, which are freely available online. Step 1. Pull up the company's balance sheet. Look for two numbers, total liabilities and total shareholders' equity. Step 2. Calculate the debt-to-equity ratio. You simply divide the total liabilities by the shareholders' equity. This ratio tells you how much the company is relying on borrowed money versus its own capital. A ratio of 1 means that for every dollar of its own money, it has a dollar of debt. A ratio of 2 means it has $2 of debt for every dollar of equity. Now, what's a bad number? This varies by industry. A utility or a real estate company can handle more debt than a software company because their cash flows are more stable. But for the average industrial or consumer company, a red flag should pop up anytime you see a ratio creeping above 1.5 or 2. Your inverted rule becomes, I will not invest in a non-financial company with a debt-to-equity ratio higher than 2. Just like that, you've eliminated a huge swath of the market filled with ticking time bombs. Step 3. This step is even more important. Go to the income statement and find the operating income, or EBIT, earnings before interest and taxes. Then, find the interest expense. Step 4. Calculate the interest coverage ratio. Divide the operating income by the interest expense. This tells you how many times the company's annual profit can cover its annual interest payments. If a company has $100 million in operating income and $20 million in interest expense, its coverage ratio is 5x. This is a healthy cushion. But what if it has $100 million in operating income and $80 million in interest expense? Its coverage ratio is just 1.25x. This company is living on the edge. A small dip in profits, a mild recession, and it will no longer be able to make its interest payments. This is the first step towards bankruptcy. Your inverted rule becomes, I will not invest in any company with an interest coverage ratio below 4x. This is a conservative but safe threshold. By creating this simple two-part filter, you are no longer guessing. You are not listening to stories. You are building a wall. You are saying, I do not know which company will be the next superstar, but I can with near certainty identify the companies that are fragile, the ones that are one bad quarter away from disaster, and I will simply not go there. This is the essence of inversion and the core of any sound investment strategy. To truly appreciate the power of this filter, we must examine the path of the 99%, the antithesis of this approach. This is the path of the growth-at-any-cost investor. This individual is captivated by narratives. They are drawn to companies that are making headlines, disrupting industries, and run by visionary, charismatic leaders. They look at the income statement and see revenues doubling year after year, and they get excited. They rarely, if ever, look at the balance sheet. To them, debt is not a risk. It's just fuel for growth, a necessary tool for aggressive expansion. They hear a CEO talk about a land grab in a new market, and they nod in agreement, not questioning how that land grab is being financed. A perfect example of this mindset was the frenzy around companies like WeWork. Here was a company with a simple, understandable business, renting office space, but it was wrapped in the language of a tech startup, with a charismatic founder and a mission to elevate the world's consciousness. It grew at a breathtaking pace, opening new locations around the globe. Investors, from retail speculators to giant private equity funds, poured billions into it. The revenue growth was spectacular, but if you had applied the debt filter, the alarm bells would have been deafening. The company was taking on billions in long-term lease obligations, which are a form of debt, and burning through billions in cash. Its balance sheet was a horror show. The business model was fundamentally fragile, dependent on a constant inflow of new capital to fund its losses. The growth-at-any-cost investor saw only the top line. They were betting on the story. The inverted investor would have asked, what happens to this business model in a recession when small businesses can no longer afford their trendy office space? How do they pay the rent on these long-term leases when their own revenue dries up? The collapse was inevitable. The IPO was pulled, the valuation plummeted by over 90%, and the investors who had chased the story were wiped out. This pattern repeats in every market cycle. Investors fall for a good story, ignore the financial foundation, and pay the ultimate price. They are playing a game of addition, trying to add the next hot stock to their portfolio. The inverted investor is playing a game of subtraction, ruthlessly removing any company built on a foundation of sand. The financial connection here is brutally direct. Debt is not an abstract concept. It is a first lien on a company's future. Think of a company's cash flow as a river. In a healthy, debt-free company, that river flows directly to the owners of the business, the shareholders. It can be used to pay them a dividend, it can be used to buy back stock, making their remaining shares more valuable, or it can be reinvested into the business to create even more cash flow in the future. Now introduce a large amount of debt. A dam is built across that river. The first and most important entity that gets water from that river is no longer the shareholder. It's the banker. The interest payments are a legally binding obligation that must be paid before shareholders see a dime. That dam diverts a significant portion of the cash flow away from the owners and into the pockets of the creditors. This has a massive impact on valuation and long-term wealth building. A company earning $1 billion with no debt might be worth $15 billion. A company earning $1 billion but having to pay $500 million in interest has only $500 million left for its owners, and its valuation will be dramatically lower. More importantly, it creates a ceiling on success and a floor that drops straight to zero. In a recession, the debt-free company might see its profits fall, but it survives. It tightens its belt and waits for the sun to come out again. The debt-laden company sees its profits fall below its interest payments and is immediately plunged into a crisis. It might have to issue new shares at rock-bottom prices, massively diluting existing shareholders. Or worse, it can be forced into bankruptcy, where the bondholders take over the company and the shareholders' stock certificates become worthless wallpaper. By simply inverting the problem and refusing to own companies that are dangerously leveraged, you not only avoid these catastrophic losses, you automatically orient your portfolio towards businesses that are resilient, flexible, and managed for the long-term benefit of their owners. You have executed the first and most important step in stock analysis. You have separated the fragile from the robust. Having built our first wall against the peril of debt, we turn to the second great cause of corporate ruin: the leadership deficit. A great business can be destroyed by a bad manager, just as a mediocre business can be elevated by a great one. The problem for investors is that we are terrible at judging leadership. We are swayed by charisma, by confidence, by a good television interview. We fall for the cult of personality. To avoid this trap, we must again invert the problem. We stop asking, "Is this CEO a visionary?" and start asking, "What are the telltale signs of a CEO who destroys shareholder value, and how can I avoid them at all costs?" For this lesson, we must turn to one of Warren Buffett's most painful and openly discussed mistakes, a story not of triumph, but of failure: the acquisition of Dexter Shoe Company. In 1993, Berkshire Hathaway bought Dexter Shoe for $433 million. This was not a small acquisition. What was unique and ultimately tragic about this deal was that Buffett paid for it not with cash but with Berkshire Hathaway stock. He was so confident in Dexter's future that he traded a piece of his own masterpiece for it. Dexter was a well-regarded American shoe manufacturer with a strong brand and a history of profitability. The management seemed solid. On the surface, it looked like a classic Buffett investment. But it turned into, in his own words, his worst deal ever. The business was about to be obliterated by cheap foreign competition. Its competitive advantage, which Buffett thought was durable, proved to be a mirage. Within a decade, the value of Dexter Shoe had gone to zero. But the real cost was far greater. The Berkshire stock he had traded for it, worth $433 million in 1993, would be worth billions and billions of dollars today. It was a multi-billion-dollar mistake. Now, the primary lesson Buffett took from this was about the importance of a durable competitive advantage, a topic we will explore later. But there's a deeper leadership lesson here. The failure wasn't just about misjudging the industry. It was about the subtle but crucial difference between good operating managers and great capital allocators. The management at Dexter may have been good at making shoes, but they were operating a business whose fundamental economics were deteriorating. And Buffett, the master capital allocator, made the mistake of allocating his own capital to a sinking ship. He paid for a business as if its past performance would continue, failing to see that the world had changed. Contrast this with his investment in See's Candies in 1972. See's also had good management, but they were operating a completely different kind of business. It had immense pricing power and a beloved brand. The key insight was how the management, led by Chuck Huggins, understood and nurtured this. They didn't try to expand recklessly across the country. They didn't dilute the brand's premium quality by chasing volume. They understood that the magic of See's was its regional dominance and customer loyalty. They were not just good operators, they were excellent stewards of the brand's unique value. Buffett's inversion lesson, learned the hard way through Dexter, was to avoid businesses where even great management is destined to fail, because the industry dynamics are working against them. He learned to seek out businesses where an average manager can succeed, because the underlying economics are so powerful, and a great manager can turn it into a work of art. The psychological trap that leads us to invest with bad leaders is the powerful authority bias, combined with the halo effect. When we see a chief executive officer on the cover of a magazine, giving a confident speech at a conference, or being praised by financial news anchors, our brain takes a shortcut. We assign them a halo of general competence. We assume that because they are successful, famous, and articulate, they must also be brilliant at creating long-term value for shareholders. We defer to their authority. We stop thinking critically. This is the CEO as celebrity phenomenon. We fall for their story, their vision, their charisma, and we neglect to do the one thing that actually matters: inspect their track record. We don't analyze their past decisions. We don't read their past letters to shareholders. We don't scrutinize how they are paid. We mistake a good salesperson for a good CEO. A CEO's primary job is not to run the day-to-day operations. It is to allocate the company's capital. They are the investment manager for the shareholders' money. They have 5 choices. They can reinvest in the existing business. They can acquire other businesses. They can pay down debt. They can issue dividends, or they can buy back stock. A great CEO does these things at times, and at prices that create value. A bad CEO does them in a way that destroys value. They buy back stock when the price is at an all-time high, just to prop it up. They make huge, flashy acquisitions at the top of the market, overpaying massively in what are often ego-driven, empire-building exercises. They dilute shareholders by issuing stock options like candy. The retail investor, blinded by the halo effect, cheers on these actions because they seem bold and decisive. They fail to ask the inverted questions. Is this acquisition actually going to earn a decent return on the price we're paying? Is buying back stock at this valuation a smart use of my capital? Is the CEO's compensation package encouraging them to think like an owner, or just to hit short-term targets that make the company look good while its long-term health deteriorates? To protect ourselves from this, we need a management vetting protocol, a mental model for filtering out value-destroying leaders. This is about replacing celebrity worship with cold, hard analysis. Step 1. Become a student of their writing. Go and find the company's annual reports and read the CEO's letter to shareholders for the past 5 to 10 years. Is the language clear, simple, and direct, or is it filled with corporate jargon and buzzwords? A CEO who writes clearly is usually a CEO who thinks clearly. More importantly, do they admit their mistakes? A leader who is honest about their failures from previous years is a leader you can trust. A leader who only talks about their successes is either lying or dangerously overconfident. Step 2. Analyze their capital allocation track record. Look at the acquisitions they've made. Did they buy a company in a hot sector at a peak valuation? How has that acquisition performed? Look at their share buyback history. Did they buy back huge amounts of stock when the price was high, and then issue new shares to employees when the price was low? This is a classic sign of a management that is not thinking like an owner. Step 3. Scrutinize their compensation. Read the company's proxy statement. How is the CEO paid? Is their bonus tied to metrics that truly build value, like return on invested capital, or growth in intrinsic value per share? Or is it tied to vanity metrics like revenue growth or the size of the company, which often encourages them to make bad acquisitions just to get bigger? And most importantly, how much stock do they own themselves? Are they eating their own cooking? A CEO with a huge portion of their net worth in the company's stock is far more likely to think like a long-term owner than one who is simply collecting a massive salary and bonus. The inverted rule here is a powerful one. I will not invest in a company where the CEO has a documented history of poor capital allocation, is not transparent about mistakes, or has a compensation structure that is not directly aligned with my interests as a long-term shareholder. This rule forces you to ignore the noise of the media and focus on the signal of past performance. The path of the 99%, the antithesis, is to become a member of the cult of personality. This investor doesn't read annual reports or proxy statements. They get their investment ideas from headlines and social media. They invest in Tesla because they admire Elon Musk's vision, without necessarily understanding the company's financials or valuation. They might have invested in WeWork because they were captivated by Adam Neumann's charisma. This approach is not investing, it is hero worship. It outsources critical thinking to a third party who, for all their visionary qualities, may not be a prudent manager of shareholder capital. The cult of personality investor believes that a brilliant founder or a charismatic CEO can overcome any obstacle, whether it's a bad business model, a mountain of debt, or a sky-high valuation. They buy the story, not the business. This path is incredibly dangerous because it is emotionally driven. When you invest based on your admiration for a person, any criticism of the company feels like a personal attack. You become defensive. You suffer from confirmation bias, seeking out only information that confirms your belief in the genius of your chosen leader, and ignoring any red flags. When the company inevitably stumbles, as all companies do, these investors are often the last to sell. Their loyalty is to the person, not to their own capital. They ride the stock all the way down, convinced that their hero will find a way to turn things around. The inverted investor, by contrast, maintains a healthy skepticism. They respect a great CEO, but they trust their own analysis. Their loyalty is not to a person, but to a process of rational decision-making. The financial connection between leadership and your returns is direct and profound. Every major decision a CEO makes regarding capital allocation is a fork in the road for your money. One path leads to value creation, the other to value destruction. Imagine a company generates $1 billion in free cash flow. A great CEO, seeing the company's stock is undervalued, uses that $1 billion to buy back 10% of the company's shares. As a remaining shareholder, your ownership stake in the business just went up by over 11%. You own a bigger piece of the pie without spending a dime. Your wealth has been compounded. Now imagine a bad CEO at the helm of the same company. They see a rival company they want to acquire. Driven by ego and a desire to build a bigger empire, they use that $1 billion, plus another $1 billion in borrowed money, to buy the rival at a foolishly high price. The acquisition struggles, profits disappoint, and the new debt weighs on the balance sheet. That $1 billion of your cash flow has not just failed to generate a return, it has been vaporized. It has actively destroyed the value of your investment. This is the daily work of a CEO, and the cumulative effect of these decisions over a decade is the difference between a stock that compounds at 15% a year and one that goes nowhere. By applying the management vetting protocol, you are directly aligning yourself with CEOs who have a proven history of making wealth-creating decisions. You are avoiding the empire builders, the diluters, and the poor capital allocators. This single act of avoidance dramatically improves the odds of your investment success, placing you on the side of value creation and away from the path of destruction. This CEO mindset is not just for entrepreneurs, it's a critical lens for any retail investor serious about long-term wealth building. We have now built walls to protect us from catastrophic debt and value-destroying leadership. Our third pillar of avoidance tackles the very essence of a business itself. It is the concept that lies at the heart of all great value investing. The durable competitive advantage, or what Buffett famously calls the moat. A great business is like a castle, and the moat is the protective barrier that keeps competitors at bay, allowing the castle to prosper for decades. To be a successful investor, You must learn to identify these moats. But following the principle of inversion, it is even more critical to first learn how to identify the businesses that have no moat at all, the ones that are destined for a life of brutal competition and meager profits. For this, we must go back to the very beginning, to the business that gave Berkshire Hathaway its name, and the painful lesson it taught a young Warren Buffett. In the 1960s, Buffett began buying stock in a struggling New England textile manufacturer called Berkshire Hathaway. He saw that the stock was cheap, trading for less than the value of the company's working capital. He was practicing what was known as cigar butt investing, looking for a discarded cigar on the street that had one last free puff in it. He thought he could squeeze out that last puff of profit as the company liquidated its assets. But he got drawn in, eventually taking control of the company. And for the next 20 years, he was locked in a brutal battle against the terrible economics of the textile industry. It was a commodity business. The only thing customers cared about was price. If Berkshire bought a new, more efficient loom to lower its costs, a competitor would immediately buy the same loom, and the savings would be competed away, passed on to the customer. It required immense, constant investment in new machinery just to stay in the game, and the returns on that capital were dreadful. Buffett later described it as a, quote, graveyard for capital. He was running as fast as he could on a treadmill, but the business was going nowhere. This painful 2-decade experience was his PhD in business economics. It taught him to invert his entire investment philosophy. He stopped asking, "How can I buy a cheap stock?" and started asking, "How can I avoid ever again owning a terrible business like this?" He began a quest to find the opposite of Berkshire Hathaway's textile operations. Businesses that were protected from the ravages of competition, businesses that had a moat. This quest led him to See's Candies, the Washington Post, Coca-Cola, and American Express. The lesson, forged in the fire of failure, was simple. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the first step is to learn to identify and ruthlessly avoid the fair to terrible businesses that have no moat. The psychological reason we are so often drawn to businesses with no moat is normalcy bias, combined with a fundamental misunderstanding of the nature of capitalism. Capitalism is a brutal, relentless force. Its natural tendency is to compete away all excess profits. If a company is making a high return on its capital, you can be certain that competitors will swarm in, like sharks to blood, to get a piece of that profit. They will copy the product, undercut the price, and they will not stop until the profits are gone. This is the normal state of affairs. Normalcy bias tricks us into thinking that a company that is successful today will continue to be successful tomorrow. We see a company with a hot product, a new gadget, a popular video game, a trendy restaurant chain, and we assume its success is permanent. We fail to ask the hard, inverted question, what is stopping someone else from doing the same thing but cheaper? We mistake a temporary advantage for a durable one. Think of all the iPhone killers that came and went. Or consider the fate of a company like GoPro. They created an amazing product and an entire new category of camera. The stock soared. But what was their moat? The brand was strong for a time, but ultimately, what stopped Sony or a dozen other electronics companies from making small, durable cameras? Nothing. Competition flooded in, the product became a commodity, and the profits vanished. The stock collapsed. The average investor saw a hit product and extrapolated its success. The inverted investor would have asked what barrier was preventing competition, and finding none, would have avoided the stock entirely. We are drawn to the story of the hot product, the new trend, but we fail to see the invisible, powerful force of competition that is always working to destroy the profitability of any business without a deep, structural, and sustainable advantage. How do we apply this principle and create a blueprint for avoiding moatless businesses? We create the moat durability test. This mental model forces us to become a corporate detective, looking for the hidden sources of a company's long-term strength. Step 1. Identify the source of the moat. There are generally 4 major types. The first is intangible assets, like a beloved brand, Coca-Cola, or a patent, a pharmaceutical drug. The second is network effects, where the value of the service increases as more people use it. Facebook, Visa. The third is cost advantages, where a company can produce its product or service cheaper than anyone else due to scale or a unique process. Walmart, Geico. The fourth is high switching costs, where it is a major pain or expense for customers to switch to a competitor, Microsoft Windows, or your local bank. When you look at a company, you must be able to clearly articulate which, if any, of these moats it possesses. If you can't, it's an immediate red flag. Step 2. Ask the inverted question. For each potential moat, you must try to destroy it. What could kill this moat? If it's a brand, a major product recall or a scandal could tarnish it. If it's a network effect, a new technology could create a better network and displace the old one, MySpace versus Facebook. If it's a cost advantage, a new business model could emerge that is even cheaper, Amazon versus brick-and-mortar retail. Step 3. Stress test the moat with the concept of pricing power. This is Charlie Munger's favorite test. If the company were to raise its prices by 10% tomorrow, would it lose a significant number of customers, or would most of them stick around? A company with a true moat can raise its prices without losing business. Think of your cable bill, or the price of a Hershey's chocolate bar. A company in a brutally competitive industry cannot. If a gas station raises its price by a few cents, customers will just drive across the street. Pricing power is the ultimate proof of a moat. Your inverted rule becomes, I will not invest in any company where I cannot clearly identify the source of its competitive advantage and confidently explain why it will be able to defend against competitors and maintain its pricing power for the next 10 years. This simple rule will force you to say no to 99 out of 100 companies, which is exactly the point. The antithesis to this disciplined approach is the trend chaser. This is the investor who is always looking for the next big thing. They are not interested in moats or durable advantages. They are interested in what's hot right now. In the late 1990s, the trend chaser bought anything with .com in its name, convinced that the internet was the future, without distinguishing between a business with a real network effect and one that was just an online pet food store with no path to profitability. In the 2010s, they chased 3D printing stocks. Then it was cannabis stocks. More recently, it's been certain electric vehicle startups or speculative technology companies. The trend chaser mistakes a growing industry for a good investment. The problem is that when an industry is new and exciting, it attracts a flood of capital and competition. Everyone wants in. Think of the early days of the automobile industry. There were hundreds of car companies in the United States. The industry was clearly the future, but almost all of those companies went bankrupt. Only a tiny handful survived. Investing in a hot trend is often a bet against overwhelming odds, because the intense competition erodes all the profits for everyone involved. The trend chaser sees revenue growth and gets excited. They see a stock price going up and experience FOMO, the fear of missing out. They jump in, buying the story of the trend, without ever asking the crucial inverted question, this is a great industry, but how will this specific company I'm buying make a profit when there are 100 other companies trying to do the same thing? The inverted investor focused on moats understands that it's not about being in the right industry, it's about owning the right business, the one that has a unique, protected position within that industry. The financial connection between a moat and your investment returns is the most important concept in long-term wealth building. A moat manifests itself on the financial statements as a high and consistent return on invested capital, or ROIC. ROIC measures how much profit a company generates for every dollar of capital that has been invested in the business. A company with no moat, in a competitive industry like an airline or a restaurant, will see its ROIC trend towards its cost of capital. This means it's essentially running on a treadmill, creating no real value for its shareholders. The money it reinvests earns a meager return. A company with a wide, durable moat, like Microsoft or Moody's, can consistently generate ROIC of 20%, 30%, or even more. This is the magic of compounding. When a company can reinvest its profits at such high rates, its intrinsic value grows exponentially. A dollar reinvested in a moatless business might be worth $1.05 next year. A dollar reinvested in a business with a wide moat might be worth $1.20 next year. That difference, compounded over a decade or two, is the difference between an average investment and a life-changing one. By inverting the problem and first eliminating all the companies that lack a moat, you are systematically removing the low ROIC businesses from your universe. You are left with a small pool of potential candidates that are true value creation machines. This is the secret to moving beyond simple stock picking and becoming a true business analyst, capable of identifying the financial fortresses that can compound your capital for decades to come. We have now erected 3 formidable defenses. We are avoiding companies drowning in debt, led by value-destroying managers, and operating in competitive wastelands with no moat. But even a great company, a fortress of a business with a pristine balance sheet and a brilliant CEO, can be a terrible investment if you make one critical error: you pay too much for it. This brings us to our 4th pillar of avoidance, the price of delusion. The most certain way to fail in investing is to overpay, to get swept up in euphoria, and ignore the sober calculus of valuation. To understand this danger, we must listen to the wisdom of Charlie Munger and his reflections on the Nifty 50 era of the early 1970s. The Nifty 50 were the darlings of their time. These were companies like Coca-Cola, IBM, Xerox, and Polaroid, seen as one-decision stocks. The idea was that they were such high-quality companies that you could buy them at any price, lock them away, and you were guaranteed to get rich. They were the blue-chip growth stocks of their day, and Wall Street fell in love with them. Investors, both institutional and retail, bid their prices up to absurd levels. It was not uncommon for these stocks to trade at 50, 60, or even 80 times their annual earnings. The narrative was that their growth was so certain and so rapid that no price was too high. Warren Buffett and Charlie Munger watched this mania from the sidelines. They agreed that these were wonderful businesses, but they were aghast at the prices being paid. They knew a fundamental truth of investing. Price is the single most important factor determining your future return. Then came the brutal bear market of 1973-74. The Nifty 50 stocks collapsed. Coca-Cola fell by nearly 50%. Polaroid fell by over 90%. The market suddenly remembered that valuation matters. But the lesson is even more subtle than that. Even for investors who held on, the experience was devastating. If you had bought these wonderful companies at their peak in 1972, you would have had to wait more than a decade just to get back to even, despite the fact that the underlying businesses themselves continued to grow and prosper. Your capital was dead money for years. The mistake was not in identifying the great companies, it was in believing that their quality made the price irrelevant. Munger and Buffett learned the inverted lesson perfectly. The question is not, what is a great company? The question is, what is a great company that I can buy at a price that gives me a margin of safety, a price that protects me from the inevitable uncertainties of the future and the risk of years of stagnant returns? The avoidance of overpayment is the final, crucial defense. The psychology behind bubbles and overpaying for assets is one of an investor's most powerful and dangerous enemies: herd bias and its evil twin, fear of missing out, FOMO. Humans are social creatures. We are hardwired to feel safe in a crowd. When we see everyone around us buying a certain type of stock and getting rich, our instincts scream at us to join in. The rising price is not seen as a sign of increasing risk. It's seen as proof that the herd is right. This is social proof in action. It feels much scarier to be standing on the sidelines being prudent while your neighbors are bragging about their profits in the latest hot stock. This creates an intense psychological pressure, a fear of being left behind. You start to rationalize. You tell yourself, this time it's different. The old valuation rules don't apply to this new technology. You abandon the discipline of analysis and surrender to the emotion of the crowd. This is the very definition of a bubble. Whether it was Dutch tulips in the 1600s, dot-com stocks in 1999, or certain speculative assets in more recent years, the psychological pattern is identical. The herd starts running, driven by a compelling narrative. FOMO kicks in, pulling in more and more people. Prices detach from any semblance of underlying value. The inverted investor must train themselves to see a rapidly rising stock price not as a cause for celebration, but as a cause for extreme caution. They must learn to hear the roar of the crowd not as an invitation, but as a warning signal. They must cultivate the contrarian mindset to calmly ask, given the price this stock is trading at today, what future growth is already priced in? And what are the odds of the company actually achieving that spectacular future? More often than not, the answer is that the price is discounting a future of flawless perfection, a scenario with no room for error, which is a recipe for investment failure. To avoid the trap of overpayment, we must build a mental model around Benjamin Graham's most famous concept, the margin of safety framework. This is the intellectual bedrock of all value investing. It is a simple, powerful idea that acts as a buffer against mistakes, bad luck, and the wild swings of the market. Step 1. Attempt to determine the intrinsic value of the business. This sounds complicated, but it doesn't have to be. Intrinsic value is simply the discounted value of the cash that can be taken out of a business during its remaining life. You can use a detailed discounted cash flow (DCF) model if you have the skill, but even simple approaches work. You can look at the company's average price-to-earnings ratio over the last decade and use that as a rough guide. You can look at what a private buyer might pay for the entire company. The key is to be conservative in your assumptions. The goal is not to find a precise number, but a reasonable range. Step 2. This is the crucial part. You must insist on buying at a significant discount to that calculated value. This discount is your margin of safety. If you conservatively estimate that a business is worth $100 per share, you don't buy it at $95. You wait until you can buy it for $75 or $60 or even $50. Why? Because you could be wrong about your valuation. The company's future might not be as bright as you think. The economy could enter a recession. A new competitor could emerge. The margin of safety is your protection against these unknowns. It's the shock absorber that protects your portfolio. Step 3. Be patient. The stock market is a manic-depressive entity. Most of the time, great companies trade at fair or expensive prices. But periodically, the market panics. There's a crash, a correction, or a sector-wide scare. Or sometimes, a great company will have a temporary, solvable problem that scares away short-sighted investors. These are the moments when the market will offer you a wonderful business at a price that provides a wide margin of safety. Your job is to have your research done ahead of time, have your watch list of great companies ready, and act with courage when others are fearful. The inverted rule is crystal clear. I will not buy any stock, no matter how wonderful the company, unless its current market price offers a significant margin of safety to my conservative estimate of its intrinsic value. This rule transforms you from a speculator into a business owner. The antithesis of the margin of safety investor is the price is irrelevant momentum investor. This individual operates under the belief that the trend is your friend. They are not concerned with intrinsic value, earnings, or balance sheets. Their sole focus is on a stock's price action. They buy stocks that are going up, hoping to sell them to someone else at an even higher price before the trend reverses. They often rely on technical analysis, reading charts and patterns to predict future price movements. This strategy can work, sometimes for long periods. It can be incredibly profitable during a raging bull market. But it is a dangerous game. The momentum investor is playing a game of musical chairs. They are completely dependent on the mood of the market. They have no anchor to value. When the music stops, when the market sentiment shifts, the exit door becomes very small, very quickly. Stocks bought on momentum can fall 50% or more in the blink of an eye, because there is no valuation support to stop the decline. The dot-com bubble is the ultimate case study. Investors were buying stocks with no earnings and no profits at astronomical valuations, simply because the price had gone up yesterday and they believed it would go up again tomorrow. When the sentiment turned in March of 2000, the collapse was swift and brutal, wiping out trillions of dollars in speculative wealth. The momentum investor who buys high, hoping to sell higher, is making a bet on market psychology. The value investor who buys with a margin of safety is making a bet on business economics. One is a speculation on emotion. The other is an investment in reality. The inverted investor chooses reality every time. The financial connection between the price you pay and the return you get is simple, undeniable mathematics. Your return is a function of two things: the growth in the underlying business and the change in the valuation multiple the market assigns to that business. Let's say you buy a great company that grows its earnings by 10% per year. If you pay 50 times earnings for it, and over the next decade, the market decides it's only worth a more normal 20 times earnings, your investment return will be terrible. The 10% annual growth of the business will be completely wiped out by the massive contraction in the valuation multiple. You paid the price of delusion. Now let's say you buy that same company, also growing at 10% a year, but you wait patiently and buy it during a market panic at just 15 times earnings. Over the next decade, as the panic subsides, the market might re-rate it to a more normal 20 times earnings. In this case, you not only get the 10% annual growth from the business, you also get a tailwind from the valuation multiple expanding. Your returns will be spectacular. The business is the same in both scenarios. The only difference is the price you paid. By inverting the problem and refusing to overpay, by demanding a margin of safety, you are not just managing risk, you are preloading your portfolio for higher future returns. You are ensuring that both the business performance and the valuation are working for you, not against you. This discipline is the final piece of the defensive puzzle, the gatekeeper of your portfolio that ensures that even your best ideas are entered into at prices that lead to success. We have arrived at the fifth and final pillar. We have built defenses against debt, bad management, weak businesses, and high prices. But there is one last trap, perhaps the most insidious of all, because it is a trap of our own making. It is the danger of venturing into territories we do not understand, of succumbing to the temptation of an investment story that lies outside our own area of expertise. This is the circle of ignorance, and to protect ourselves, we must heed Buffett's most famous personal rule: the paramount importance of staying within your circle of competence. The most powerful act of inversion is to first clearly define what you don't know, and then have the discipline to never, ever invest there. The quintessential story of this principle in action is Warren Buffett's famous refusal to participate in the technology stock bubble of the late 1990s. As the dot-com mania reached its zenith, Buffett and Munger looked like fossils. The world was changing, and they didn't seem to get it. Technology stocks were soaring to unimaginable heights. Companies with no profits, and in some cases no revenue, were achieving market capitalizations larger than established industrial giants. And Berkshire Hathaway, filled with boring insurance companies, candy makers, and furniture stores, was dramatically underperforming the market. The media began to openly question if the Oracle of Omaha had lost his touch. A famous cover of Barron's magazine in 1999 featured the headline, "What's wrong, Warren?" The pressure to join the party must have been immense. His investors were questioning him. The media was mocking him. But Buffett's response was simple and unwavering. He said, "I don't understand these businesses." He couldn't, with any certainty, project what their earnings would look like in 10 years. He didn't know how to distinguish the eventual winners from the horde of competitors. He didn't have a handle on their competitive advantages or how durable they might be against the blistering pace of technological change. So he did nothing. He inverted the problem. Instead of asking, "How can I figure out which tech stock to buy?" he asked himself, "In which areas am I most likely to make a catastrophic mistake due to my own ignorance?" He identified technology as a primary danger zone for him, drew a circle around it, and refused to step inside. When the bubble burst in 2000 and the Nasdaq crashed by over 75%, wiping out trillions in wealth, Buffett's discipline was vindicated in the most dramatic fashion. He didn't need to predict the crash, he just needed to be honest about the limits of his own knowledge. His refusal to play a game he didn't understand was one of the most profitable decisions of his career. The psychological force that pushes us outside our circle of competence is a deadly combination of overconfidence bias and the Dunning-Kruger effect. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. In investing, a little bit of knowledge is a very dangerous thing. A retail investor might read a few articles about a new field, like artificial intelligence, gene editing, or cryptocurrency. They learn the buzzwords. They can follow the basic narrative. This initial burst of knowledge creates a feeling of expertise. They start to believe they understand the field deeply enough to pick the winning companies. This is their overconfidence bias kicking in. They dramatically overestimate their own analytical edge and underestimate the vast, complex, and highly specialized knowledge required to truly understand these cutting-edge industries. They don't know what they don't know. They hear a story about a small biotech company with a promising new drug and they think, this could be the next big thing. They don't have the scientific background to evaluate the clinical trial data. They don't understand the complex FDA approval process. They don't know the competitive landscape of other drugs in development. They are, in effect, gambling on a story. The inverted investor fights this tendency with intellectual humility. They accept that the world is too complex for any one person to be an expert in everything. They are not afraid to say, I don't know. In fact, they see those three words as a source of great power, a shield that protects their capital from their own ego. To put this final principle into practice, you must engage in an exercise of radical self-honesty. You must create the map of your circle. This is the most personalized mental model in our arsenal. Step 1. Take out a blank piece of paper. In the center, draw a small circle. Inside this circle, you will write down the industries, businesses, and technologies that you understand deeply. And you must be brutally honest. What qualifies? This knowledge usually comes from your profession. If you're a doctor, you understand the healthcare system, hospital administration, and medical device companies. If you're a software engineer, you understand software as a service business models and the competitive dynamics of the tech industry. It can also come from a deep, lifelong hobby. If you've spent 20 years as a passionate video gamer, you probably have a better understanding of the gaming industry than most Wall Street analysts. This small circle is your area of expertise. These are the businesses where you have a potential edge. Step 2. Everything else in the universe of investing, every other industry, every other company, lies outside that circle. This vast outer region is your too hard pile. It's not a reflection on your intelligence. It is an acknowledgement of specialization. Warren Buffett puts technology companies in his too hard pile. A brilliant tech investor might put insurance companies in theirs. Step 3. Make a sacred vow to yourself. This is your inverted rule, the final law of avoidance. I will not invest a single dollar in any company that falls outside my circle of competence, regardless of how promising it sounds, how much the stock is going up, or what anyone else tells me. This rule is your ultimate defense against the most dangerous person in your financial life, the overconfident version of yourself. The antithesis to this disciplined approach is the jack-of-all-trades, master-of-none investor. Their portfolio is a chaotic reflection of recent headlines. One month, they're buying a Canadian cannabis company because they read an article about legalization. The next, they're buying a Chinese electric vehicle startup they heard about on social media. Then they're speculating in a cryptocurrency that their friend's cousin recommended. They have no coherent investment strategy. They are simply chasing stories. If you were to ask them to explain the business model of each company they own, to articulate its competitive advantage and its primary risks, they would be unable to. They don't have an opinion. They are merely renting the opinions of others. This is not investing. It is a form of financial entertainment, and it almost always ends poorly. Because they have no deep understanding of what they own, they have no conviction. When one of their stocks inevitably falls 20%, which all stocks do from time to time, they panic. They have no way to judge whether this is a temporary setback and a buying opportunity, or the beginning of a permanent decline. Their ignorance makes them fragile. They buy at the peak of excitement and sell at the trough of despair. The investor who stays within their circle of competence operates from a position of strength. When a stock they own falls, they can reevaluate their thesis based on their deep knowledge. If the facts haven't changed, the price decline is a gift, an opportunity to buy more of a great business at an even better price. Their knowledge is the source of their conviction, and their conviction is the source of their long-term returns. The financial connection here is the ultimate determinant of your ability to behave rationally. Investing is not just an intellectual game, it is an emotional one. The greatest threat to your long-term wealth building is not a bad economy or a market crash. It is the risk of you, yourself, making a foolish, emotionally driven decision at the worst possible moment. When you invest in something you don't understand, you are setting yourself up for emotional failure. You have no anchor, no foundation of knowledge to hold on to when the storm hits. Your decisions will be driven by the primal emotions of fear and greed. Staying within your circle of competence is the ultimate form of risk management. It ensures that you are always playing a game where you have an advantage. It gives you the conviction to hold on during tough times and to add to your positions when prices are low. This emotional stability, born from genuine understanding, is the secret ingredient to compounding your capital over a lifetime. It is the final, essential piece of the puzzle. By defining what you don't know and refusing to go there, you complete the fortress of avoidance. You have created a system, a powerful mental machine for eliminating 99% of bad ideas, leaving you with a small, manageable, and deeply understood universe of high-quality opportunities. You have stopped hunting for winners and have instead mastered the far more powerful art of avoiding the losers. You have made it to the end of this journey, and in doing so you have acquired something of immense value. You now possess the mental tool of inversion, the same powerful framework used by the world's greatest financial minds to transform overwhelming complexity into profound clarity. You've learned how to stop chasing the impossible dream of finding the next winner, and instead focus on the achievable, rational goal of avoiding the obvious losers. You have learned how to build a fortress of avoidance, with walls designed to protect you from the death spiral of debt, the folly of bad leadership, the wasteland of businesses with no competitive moat, the delusion of paying too high a price, and the siren call of investments that lie outside your circle of understanding. This is not just another investment strategy, it is a fundamental upgrade to your decision-making operating system. But it is crucial to understand that this powerful defensive system you have just built is one half of a much larger architecture of rational thought. Inversion is the unshakable foundation. It clears the field of all the landmines and traps, ensuring your survival. But what happens next? How do you move from simply avoiding failure to actively identifying and seizing the truly rare, once-in-a-generation opportunities? Avoiding the 99% of bad stocks is step one. But what are the specific, often counterintuitive characteristics of the top 1% that remain? This powerful principle of avoidance is interconnected with other mental models for concentration, for patience, for understanding market psychology. You have mastered a single crucial piece of the map. The video that YouTube is showing you on the screen right now is not an accident, it is the next piece of that map. It is the bridge between the world of defense and the world of offense. It is the link that connects the strategy of avoiding the bad to the strategy of compounding the great. You have just learned how to build your shield. The next step is to learn how to wield the sword. You have proven you are not a speculator. You are not a gambler looking for a hot tip. You are an architect, carefully and patiently building the framework for your own financial freedom. The casual viewer, the tourist, stops here, satisfied with the knowledge of how to avoid disaster. But the true builder, the individual committed to assembling a complete mental arsenal for wealth building, recognizes that the foundation is just the beginning. The click you are about to make is not just to watch another video, it is a declaration that you are continuing your ascent, It is a choice to complete the arsenal. Click and claim the next tool.